All right, let's talk about private credit. It's one of the hottest, fastest growing corners of the financial world, and it's been attracting just a massive amount of investment. But what if that whole gold rush is masking some really serious cracks in the foundation? Today, we're going to dive into the bearish case for private credit and explore the vulnerabilities that might be hiding just beneath the surface. So, first things first, let's just wrap our heads around the scale we're talking about here. This isn't some niche market anymore. We are talking trillions of dollars. This whole thing has ballooned from a pretty small alternative into a frankly systemically important part of the entire global financial system. And that really gets to the heart of it, right? With so much money pouring in, with such incredibly rapid growth, has the market just gotten overheated? Has the mad dash for returns created vulnerabilities that maybe we just haven't seen yet? To really get the risks, you have to start at the source, the absolute flood of capital that is poured into this space. I mean, it's been nothing short of a gold rush. And this is where we hit the fundamental tension behind the whole bearish argument. You've got this gigantic, ever-growing ocean of money from investors who are just desperate for yield. But there are only so many good companies out there to lend to, and that creates this intense competition among the funds. So what happens next? Well, that fierce competition has very real consequences. You know, when everyone is fighting for the same deals, something's got to give. And in this case, what's giving way are the standards and the protections that are supposed to keep lenders safe. To really understand this pressure, you need to know a key term: dry powder. It's this massive pile of uninvested money that funds have already raised but haven't actually put to work yet. The fund managers, well, they are under immense pressure to deploy that cash to start earning returns, and that pressure can lead to some pretty big compromises.
So what's the biggest compromise we're seeing? It's the rise of so-called covenant-light loans. Basically, to win a deal, lenders are stripping away the covenants. And those are the rules, the protections that are supposed to keep borrowers in check. The company gets a ton more freedom, sure, but the lender is left way more exposed if things go south.
So when you add it all up, you get this situation where lenders are fighting so hard to use that dry powder that they're accepting weaker protections, and sometimes even for lower returns. They're taking on more risk for potentially less reward, which, let's be honest, is a recipe for trouble down the line. But that's just one piece of it. Here's the second major part of the bearish case. All of this rapid growth, all these weaker deals, they've all happened during a period of relative economic calm. This entire market has never really been put through a true, prolonged stress test. I mean, think about it. The explosive growth phase for private credit took place in an era of historically low interest rates and pretty steady economic expansion. Its resilience in a really severe, long recession is a complete unknown. We just don't know how these weaker, covenant-light loans are going to perform when corporate defaults really start to pile up. And in a downturn, what's normally a core feature of private credit can suddenly become its biggest weakness: illiquidity. See, a public bond? You can sell that on the market almost instantly, even if it's at a loss. But a private loan is a direct deal. You can't just offload it. The lender is stuck. You could almost picture the dominoes, right? A recession hits, more borrowers start to default. But because the loans are illiquid, lenders are stuck holding these bad assets. They get forced into these long, costly restructurings, and those fantastic returns they promise their investors, they can just evaporate. And there's one more major risk factor in all this. When a market grows to become a multi-trillion-dollar pillar of the financial system, well, it inevitably gets the attention of a whole new group of people, the regulators. And you better believe they are now watching very, very closely. And that's exactly what's happening. Policymakers are starting to get concerned that this market might now be too big to fail. Its connections to the rest of the financial world are so deep that a problem here could easily spread everywhere else. So yeah, they're starting to ask some pretty tough questions about transparency and risk. This new scrutiny could totally change the game. We could see new rules pushing for more standardized reporting and transparency, which would definitely increase cost for these funds. Regulators might also start putting limits on how much risk funds can even take on. And all of this could end up constraining the very flexibility and agility that made private credit so attractive in the first place, potentially slowing the whole thing down. So when you put it all together, the crazy competition, the fact that the market is totally untested, and this looming shadow of regulation, it really paints a picture of a market at a critical crossroads. Okay, so let's recap the whole bearish case. It's not saying private credit is doomed, not at all, but it does highlight three very real risks. First, you've got intense competition that's watering down lending standards. Second, the entire model is basically untested by a major downturn. And third, growing regulatory scrutiny could take away the very advantages that fueled its incredible rise.
And that leaves us with the big trillion-dollar question. Has the private credit market built a truly resilient, all-weather model for lending? Or has its rapid, unchecked growth created the perfect conditions for it to become the source of the next financial crisis? Honestly, only time and the next economic cycle will tell.